The U.S. Federal Reserve has held its overnight rate steady for a fifth straight meeting, keeping it at a range of between 4.25% and 4.5%. Joining me now to discuss is Scott Colborn of TD Asset Management. And Scott, thanks for joining us. As expected, the Fed kept its interest rate on hold despite a lot of political pressure for aggressive cuts. What stood out for you today?
Well, I mean, the market wasn't expecting them to cut, so that was pretty much as expected. We did see the two dissents. One was really telegraphed earlier from Waller, so that largely as expected. I think we're focusing on how the Fed is characterizing inflation, employment, and the economy. And for the most part, the Fed has characterized today in its statement that inflation remains somewhat elevated. The labor market remains solid. But it did acknowledge that we're seeing some moderation in the economy. And so that is sort of leading us towards the end of the year into the September meeting and where we go from there. Certainly there is lots of political pressure, and we see that regularly.
Okay, I want to talk about those dissents because, as you mentioned, the central bank's decision was not unanimous. Two Fed governors dissented from the policy call for the first time since 1993. What are the implications for monetary policy going forward?
Well, I know right after the Fed announced today's press release, President Trump did say, I hear they're cutting in September. So it's intense. The political pressure is very focused. The markets have about a 2/3 a chance of a Fed cut priced in right now. So we're going to be getting data between now and then that will allow the Fed to shape its decision. I think really what you see it in terms of the bond market is the shape of the yield curve, the combination of the fiscal aspect of issuance of debt plus the pressure in what we would largely characterize as a fairly good employment market, 4.1% unemployment, a moderating economy, yes. But inflation is somewhat sticky as well, and so in that sort of mixture, you wouldn't be expecting the Fed to cut. So this really affects the shape of the yield curve with a steepening bias, where we see the long end underperforming the front end of the yield curve.
I want to talk a little bit about the economy because so far the U.S. tariffs are not having that inflationary impact that many economists had feared. There is some stickiness to it, but what do you attribute that to, and are calls for a rate cut warranted?
Well, I mean, I think the Fed pushed back today on sort of that imminent political pressure. What we see is, tariffs take time. The number in January, the average tariff rate was around 2-3%. It's now up closer to 17% in July. It's going to take time for tariffs to pass through. The indications are sort of 6 to 18 months is sort of a pass-through time. We've seen some evidence in CPI that some of the goods prices are a little bit stickier. Inflation swaps markets, the markets that the bond market focuses in on, inflation remains elevated. So I think net, the market is cognizant that there is pressure. We'll continue to see pressure into the balance of this year into the new year. So they're pushing back against this narrative, particularly as Governor Waller articulated that it's a one-time pass-through effect of inflation. The market is saying, "Show me the evidence." It's not there, and I think that's the tension and the debate that is evident in the Fed right now.
Okay, let's switch over to talking about the tax bill, the one big, beautiful tax bill, which was signed into law earlier this month. That's raising concerns over government spending. What are the implications for Fed policy and bond markets going forward, given that this bill has now passed?
Yeah, the pressure from the fiscal side or the stimulus side is predominantly on the shape of the yield curve and how the Treasury manages the issuance. Today we had the refunding announcement. Largely as expected, for the sixth consecutive quarter, issuance is about as expected. There was some indication that we got a little bit of a buyback program going on in the 10-year and out part of the yield curve. maybe a nudge towards, the Treasury acknowledging that there's going to be pressure on 10 and 20 and 30-year bonds because of the fiscal issuance, because of the stimulus on the fiscal side. So I think the Treasury is aware, and I think we'll see into September, into the balance of the year, the Treasury will get one more crack at managing the shape of the yield curve through the issuance.
Okay, let's talk about the U.S. dollar. I want to get your outlook on the dollar, which seems to be kind of caught between two opposing forces. We've got the resilient economy and trade deals on one side against the political interference and uncertainty over the Fed's next move. Where do you see the U.S. dollar going forward?
Yeah, I would characterize what we've seen this year as a dialing back of the U.S. exceptionalism story, and it fed through into the activities of global asset managers, fast money, real money, sovereign wealth funds, and they hedged a lot. They hedged more of their U.S. dollar exposure, right? A lot of this was unhedged. That is out of the way now. So now we're at the cross, just as sort of both sides of the coin are out there, right? Fed rates on hold. There is a bounce back in the equity market, so U.S. dollar assets are performing well. But there is sort of this political pressure and this, desire for the political administration to have a weaker dollar. So that tension's at play. It's a little bit more of a balanced story right now. Ultimately, I do think that the U.S. dollar weakness story plays out, but right now we're in that in-between point of the market.
Okay, so as we await the next Fed decision, which will be in September, what will you be watching closely to kind of get a sense of what the Fed's next move will be?
In the very near term, this Friday, we have the non-farm payrolls, so that'll give us an indication. The Fed characterized the labor market today as solid. So do we see any more cracks in the labor market? And then between now and September, which is when the Fed is going to next meet and produce the summary of economic projections, we'll have 2 employment data and 2 CPI. And I think even if the whole debate there's not complete clarity, I think it gives enough evidence to the Fed to either stay on hold for the balance of the year or start cutting.